Is whole life insurance a scam? No, but it gets a really bad rap from the content creation sphere, from gurus, and from people who maybe had an agent that sold them one and they just had a bad experience with it. Most agents may sell whole life as this really great thing that can make you a lot of money and it'll grow as your family grows. But in the honest truth, most of the time those policies don't get structured in the way to achieve those goals. And that becomes a big problem because people feel like they were told one thing, but then got another thing. I own both term and whole life. I sell both. And so I'm going to give you my opinion coming at this not just from one side, but from both sides of owning and selling. I think in a way it makes sense that whole life gets the bad rap. I think in a way it makes sense that whole life gets the bad rap that it has. In my opinion, term and whole life, they solve two completely different problems. In term's case, it's strictly for protection in my view. In whole life's case, I think it's more of a investing vehicle, and for individuals who just want to protect their family with some life insurance, it's probably not the right product for you. So where do people get the scam part for whole life? What is the thing that makes people say, oh, this is a scam, this is not worth it, just buy term instead? So whole life gets sold as this product where you can put money in and it will grow at a certain percentage safely over time. And because the policy is set for the entire lifetime of the person who has it, that means that when you end up dying, your family can inherit that money and it's tax-free. Because it's used as an investing vehicle, the amount of money that you put into it tends to be a lot larger. So for example, if you have a term policy, you may have a $60 term for $1 million that you're paying for. With the whole life, it's the same policy. You're paying for about $1 million, but you may be putting in $600 a month instead of $60 a month. With the term's not going to grow, right? It's just for protection. You're just paying something and you'll get something out of it. But with the whole life, you put the money in and then that money can grow and then you can borrow against it. So you put $600 in, it grows into the cash value. And at some point, if you want to use that money, you can borrow from it and use it, which is not available in a term policy. But here's where it goes south real quick. Let's take an example. Let's say you're paying in $10,000 a year, just for easy maths, into your whole life policy, okay? And it's sold to you as, okay, you're gonna put 10,000, but you'll have this cash value that'll accumulate into the whole life, and then you'll be able to draw from that. Well, there's multiple ways to structure a whole life policy, and if when it's structured year one, you end up having zero cash value, so you put $10,000 in, but there's zero cash value, that is a huge problem for a whole life policy. And most of the time, that's the way it gets structured. For most people, when they look at that, even though they may not be understanding what is going on in a whole life policy, the gut feeling is to say, well, something's off in this thing. How can it be that I'm paying so much money up front and I get so little out of it in even the first year? To compound on that point, usually the break even of those types of policies is about 15 years. So you would need to be paying 15 years into the policy, $10,000 a year, to finally get to the break even of getting what you put in, equaling what's in the cash value. So that's a long time to be paying into that policy before you actually get to the break-even point. So for most people, it's just easier to say, hey, look, this is a scam. Don't go for it. Don't buy it. It's not the right policy for you. But when whole life is structured properly, where if you're paying that same $10,000 in every year, if year one, you're getting about 80 to 90% of that money in cash value. So you pay 10,000 in 1 year, you have about $8,000 to $9,000 accumulated in cash value not $0, then that's where what people are talking about, why a whole life is such a great product for putting your money in and having it grow, at a rate of 3 to 4% per year. That's where that comes from. But most people don't see that because whoever they're working with maybe doesn't know how to structure a policy like that to where they can get that, or maybe they don't want to do it. And that's why when you do work with somebody, you got to work either with an agent who knows what they're doing, and you honestly have to know a little bit about this too, or you have to work with a fiduciary who gets paid by the hour, but they are doing it in whatever is in your best interest, not in their pocketbook's best interest. So there's multiple ways to kind of structure this. And the ideal way is where you maximize cash value growth and you limit death benefit growth, because that's the only way to do it. So in that case, in the same scenario, you may be paying $10,000 in, you'll be able to get, $8,000 to $9,000 in cash value year one, but your death benefit of your policy may only be like $300,000 or $400,000. It's not going to be the same $1 million, which your term, if you're just paying $60 a month, may be able to get you. And that's why for most gurus, they'll tell you, oh yeah, it's a scam, stay away from it, because the honest truth is that reality is more complex and nuanced. It's not a scam, but if you don't know how to structure it properly, if you don't know the ins and outs of it, it can become a real complicated thing to try and figure out. And so it's just easier for people to say, yeah, just stay away from it, get term instead. And in one sense, if all you're looking for is just as much death benefit as possible in order to protect your family, whole life may not be the right product for you. Whole life is for those individuals who maybe have maxed out their retirement plans, 401ks, Roth IRAs, all that stuff, and they're looking for putting their money in someplace safe, and maybe they don't even want to be in the market because they don't trust the market. They want something way safer than that, and with whole life, that can get you there. It could be a 3 to 4% annual rate of return. But even with the structure that I mentioned where you maximize cash value so that you can get as much of that money available to you from even year one, the break-even point is usually about year 5 or 6. And the way that you would want to structure is where you don't pay for the rest of your life. So for example, you could do what's called a 7 pay, which means you pay for 7 years, and after year 7, boom, your payments stop. Your policy is going to be enforced, meaning it's not going to be canceled or anything, but you've paid up, you're not going to pay any more into it, and now the money is just going to keep on accruing that interest and keep on growing. So in that sense, whole life can be a really good product for some people. But if you're just worried about strict protection, you're just a parent, and you're not looking to get into this complicated investment vehicle, which I think it's an investment vehicle in my opinion, then just don't even worry about whole life. I think for most people, term is probably the right product for them. So whole life and term, 2 different tools, 2 different jobs. Whole life isn't a scam, but if the way you get it structured isn't properly handled, it may feel like that. But term is usually what more people need. So I hope this answered the question for you guys, but if you have any further questions or things you want me to explain more, just put it in a comment down below and I'll be able to get to it and answer those questions too. Thanks so much.